If you run a business, you may incur different types of expenses. These can be things such as rent and advertising, or larger purchases such as a company car or machinery. These are two different aspects of running a business, such as operating costs or fixed assets. Within this video, we will explain what the difference is between the two and how each of these will affect your business. Hi, my name's Adam and I'm an account specialist at Easy Digital Filing. Whether you have a small business or you just wish to better understand business finances, this video will help you understand. Let's start. Operating expenses are the expenses that a company will incur on a day-to-day basis. These could be things such as advertising, admin, purchasing office supplies, or rent. These items would then be deducted against the company's taxable income at the end of the year, which would therefore reduce the tax at the end of the accounting period. Operating expenses may fall into different categories depending on what they're used for. The first category would be cost of goods sold. These are the costs directly related to the product or service that your company provides. If you manufacture products, these would be the raw materials used to provide your good or service. For example, if you run a bakery, this would be the sugar or flour used to make your goods. The next category would be general and administrative expenses. These would be things such as advertising, office expenses, or legal fees. These are expenses that are necessary to run the business but may not directly relate to the product or service that you provide. Some assets lose value over time, and instead of including the full cost at once, we spread their expense out over time. This is called depreciation when it's a physical item, such as a car, or amortization when it's an intangible item, such as a patent. Lastly, there's non-operating expenses. These are expenses that need to be paid by the business but aren't directly related to the running of the business. These can be items such as bank fees or loan interest. All operating expenses would be included on the income statement and therefore would reduce down the taxable income at the end of the accounting period. Now we're going to take a look at fixed assets and how these are treated differently. Fixed assets are items that a business purchases to be used for longer than 1 year. These aren't daily expenses, but instead an investment in the business to help it grow. These would be items such as buildings, machinery, vehicles, or computers. Since fixed assets are to be purchased for a long period of time, their expense isn't included all at once. Therefore, it is included on the balance sheet, and slowly we include their cost in the income statement through depreciation or amortization. Depreciation is a way of spreading the cost of a fixed asset over its useful life. Instead of including its full expense in the year it was bought, we will then spread the cost year by year. Businesses use depreciation to get a more accurate picture of its finances at the end of the accounting period, instead of including large purchases as a one-time loss. Although depreciation is a disallowable expense and therefore is added back to the taxable income within the corporation tax return. If you decide that a fixed asset is no longer required, it can be sold or disposed of. If it is sold for more than its recorded value, this should be recorded as a profit on the income statement. If the item is sold for less than its recorded value, then this should be shown as a loss. One major difference between operating expenses and fixed assets is how they are treated for tax purposes. Operating expenses are deducted right away from the taxable income, but fixed assets do not provide any immediate tax benefit. Instead, you can claim capital allowances on the fixed assets acquired within the period. Capital allowances act as a tax relief for the purchase of fixed assets within an accounting period. Depending on the type of fixed asset purchased, will affect the type of capital allowance that can be claimed. The most popular capital allowance is Annual Investment Allowance, also known as AIA. This allows companies to deduct up to 100% of the value of the qualifying equipment at the end of the accounting period up to £1 million. There are other capital allowances which can be claimed, such as first year allowance or writing down allowance, which allow you to deduct the value of the item over multiple years. To summarise what we've learned today, both operating expenses and fixed assets are important to a company, but they're treated differently. Operating expenses are the daily costs incurred by a business. These can be deducted immediately from the taxable income at the end of the accounting period, whereas fixed assets are a longer-term investment which should be deducted gradually through depreciation. The government allows companies to claim capital allowances on fixed assets which allow them to reduce their tax bill. Understanding the difference between the two is important to helping the company make better financial decisions. If you found this video helpful, please like and subscribe for more business finance tips. You can download the slides from this video using the link in the description. If you have any questions, please feel free to ask them in the comments and we'll be happy to help. Thanks for watching and see you in the next video.